July said slow down, but August said not so fast. Hey, it's Eric Osnes here with Homebridge Financial Home Mortgage with my weekly update on mortgage rates and the economy for the week ending September 16th, 2022. Holy cow, summer's almost over here. Well, it's been a rough couple of weeks in the financial markets as data releases were not friendly for interest rates. The consumer price index for August surprised everyone. It came in worse than expected. The overall inflation rate dropped 8 to 8.3% from 8.5. That part's good. But the core rate, which strips out food and energy, was double expectations, increasing by 0.6%. Same thing for the producer price index, PPI, where the core rate rose 0.4%, which was much higher than expectations. Retail sales for August are also stronger than expectations. But if you strip out auto sales, gasoline, building materials, and food services, it was flat. That's important because core sales, which is what that is, are factored into GDP calculations and should result in a negative revision to the third quarter estimates. That would give us one of the slowing signals that we're so desperately looking for. Also, last week, jobless claims came in stronger, decreasing by 5,000 to 213,000, the lowest level since May. Why are all these statistics important? Well, because mortgage rates fall on signs of a slowing economy. The strong August numbers reverse the belief we had in July that the economy was already making its turn downward. It's unfortunate that the Fed was so late to address inflation. They didn't stop printing money until this spring, and by then inflation was already out of control. And inflation drives mortgage rates. You can really see it if you click on my links. If you're looking online, you'll see a chart. Mortgage rates track almost perfectly with inflation, except during the period of quantitative easing, which ran roughly from about March 2020 to March 2021. That's because during QE, the Fed was purchasing up to $120 billion in Treasury and mortgage securities every month, keeping the rates artificially low. When QE ended, mortgages went right back to tracking with inflation. I guess the fact that rates track with inflation is actually probably good news because inflation should start to decline as we get into fall and winter. Why? Just the math. CPI is a 12-month rolling average. Every month we replace an index from a year ago with the current index. And as we get into the fall months, we'll hopefully be replacing higher CPI numbers from a year ago with lower ones, fingers crossed. As that happens, mortgage rates should fall. For the week, though, mortgage rates were higher, dealing with all these statistics for strong August numbers. Here are the national averages. Conventional 30-year fixed rate, 6.33%, up over the 6% mark, up 0.32 from last week. 15-year fixed rates, 5.55%, up 0.26. FHA and VA 30-year fixed rates, 5.6%, up 0.2. And jumbo 30-year fixed rates, 5.65%, up 0.4. Now, how about some good news? Conforming loan limits are going up. Every year around Thanksgiving, Fannie Mae and Freddie Mac announced the conventional conforming loan limits for the following year. This year, a few lenders, including us, we jumped on the bandwagon, jumped the gun, increased our loan limits in anticipation of this announcement. Our new conforming loan limit for 2023 is increasing by $67,750 to $715,000. That conforming loan limit is important because the conforming loans allow you to have the lowest down payments, as low as 3% down, as well as some of the best interest rates. Now, the limits will vary state by state, county by county. And there's a second tier of loan limits called high balance loan limits that impact King, Pierce, and Snohomish counties in Washington. Now, those limits have not yet been announced and probably won't be until the official federal announcement comes out, which is typically on Black Friday. Currently, our high cost limit is at $891,250, and I'm pretty sure that we'll see a nice boost to that number as well. I'm available to answer your questions, help run numbers, solve problems. We've got some real creative ways to keep your payment down in these crazy times in anticipation of the lower rates that are sure to come in the near future. Reach out. You can call me anytime, 206 915-3742. That's 915-ERIC. Or you can email me, eric@ericismybanker.com. Check me out on social media, Eric is my banker, and be sure to subscribe to my YouTube channel so you don't miss any of these weekly updates. That's it for me for this week. I hope you have a great weekend. Talk to you next week.